Joining us right now to talk more about what investors should be bracing for is Sharmin Mossavar-Rahmani. She is Chief Investment Officer at Goldman Sachs Private Wealth Management. And Sharmin, let's talk a little bit about what you've said over the weekend. You said you think that there is light at the end of the economic tunnel, but now we're hearing from the White House that they're pushing back social distancing to April 30th. June 1st is kind of being talked about as a potential time when we do break out of something like this. Have you kind of put that into your equation already?
Based on the panel of experts that we talk to on a pretty frequent basis, the thought that you need to maintain social distancing for some time is actually what will help us at the end of the tunnel in terms of the recovery. If we abandon social distancing too quickly, in fact, the risks are greater in the long run. So the fact that that has actually been pushed back, we think, is a big plus. We think the size of this fiscal package, all the monetary policy measures are very significant, very large, and have been actually enacted in a very short period of time relative to the global financial crisis. So all of that together gives us a sense that there is a light at the end of the tunnel for most of us. Obviously, for those in the healthcare industry, in the front lines, public health officials, nurses, doctors, it's a very different situation. But for the economy and the financial market, the social distancing actually is a good thing in the long run.
Sharmin, you're in the private wealth management business. What do you hear from your clients these days? How panicked are they, or how much are they willing to maybe put some extra money to work now that we've seen the markets come down so significantly?
It's a very mixed picture in terms of how different clients react. We always recommend clients have a very good strategic asset allocation. So the ones who have started with a good strategic asset allocation where they're comfortable with their mix of equities and fixed income, they have more staying power. We have been recommending that they lean in a little bit into this market to slowly start adding to their equity risk. Initially, we had recommended they do it in a more conservative fashion using some option strategies. Early last week, starting Monday, we actually recommended incrementally actually adding to equities outright. We have generally recommended U.S. equities. We would rather tactically be in U.S. equities with the greatest liquidity in the market, the greatest transparency, and where the policies are very coordinated. So clients have asked us whether there are other markets or other sectors they should be looking at, and we have recommended staying focused on the S&P 500. There are others who have asked whether this is a light at the end of the tunnel or an oncoming train. And that's why actually the title of our last Sunday Night Insight was that we didn't think it was an oncoming train, other than, again, for the healthcare industry.
So your reasons for starting to push your clients more aggressively into U.S. stocks a week ago, was that because stocks had come down so precipitously, or was that because you started to think, okay, we think we have a handle about how we're going to manage coronavirus here in the United States?
I think it's definitely too early to have a strong opinion on how coronavirus the spread will be dealt with. It's too difficult in that there's not a social distancing practice, as you discussed in the prior session, across the board. So it's hard to know exactly the path, but eventually social distancing does turn the curve or flatten the curve, as is commonly used. And so we will see a decrease. We don't know when that will happen and what the peak level will actually be, but we know that it is going to happen. The amount of work that's being done on therapies and vaccines is enormous, and there's a sense that eventually, whether it's off-the-shelf, repurposed drugs, or new drugs, we will see some progress, and that should lead to some optimism. But we also try to put this big downdraft in context. So if we look at high to low, whether it's close of business to close of the market or whether it's intraday, we're looking at a peak to trough drawdown of about 34-35%. And when we put that in context, we can look at other episodes. So in other recessions, we've seen numbers down 40%. If we think of the global financial crisis, we've seen a downdraft of nearly 60%. We tried to put that also in the context of major pandemics like the Spanish flu, like World War II, in terms of destruction and try to put some context around these numbers. Nobody knows exactly where the bottom is, and we try to make sure our clients are aware of the fact that nobody knows whether the numbers we saw on Friday and parts of the sort of the 2,200 level is the lows, or whether we're going to retest those lows. So obviously we recommend clients start leaning in if they have some staying power and they can withstand the volatility. In that case, we say that this drawdown has been very significant. The amount of resources dedicated to solving the problem, as well as providing a floor to the economy and providing tremendous liquidity so the financial markets can operate and function, that eventually things will improve. And the markets tend to discount that sooner rather than later. And so we need to slowly start averaging in.